All right, let's jump right in. Today, we're taking a seriously paradigm-shifting journey into how we price two of the most elusive things in finance: uncertainty and flexibility. In this explainer, we're going to tackle a concept that literally changes how you view risk and value from the ground up. It's called contingent claim valuation, though you might know it better as option-based valuation. So if you've ever found yourself wondering how on earth you put a price tag on a project that might totally flop, or a patent that isn't viable yet, or even a company that's completely drowning in debt, well, you are in exactly the right place. Okay, let's kick things off with a classic thought from Oscar Wilde, quoted right at the top of our source material. He said, "A cynic is one who knows the price of everything but the value of nothing." It's a fantastic hook, right? Because it perfectly establishes a core truth of finance. True valuation, it's about so much more than just glancing at a current price tag or tallying up predictable cash flows. You really have to look at the hidden potential, the flexibility, and the choices embedded deep within an asset. So here's our game plan for today's explainer. We'll start with the three approaches to valuation, look at the option pricing revolution, and dive into the mechanics of calls and puts. Then we'll shift to valuing real options, treat equity as a call option, and finally wrap up with the true value of flexibility. Let's get to it. Kicking off with part one, the three approaches to valuation. Before we can really appreciate the revolution here, we've got to understand the establishment. There are three main ways to value an asset. First up is discounted cash flow, or DCF, which just finds the present value of expected future cash flows. It's literally the foundational tool of finance. Second is relative valuation. This is pricing an asset based on comparable stuff. Think of pricing your house based on what your neighbor just sold theirs for. And finally, number three, contingent claim valuation, which uses option pricing models. Now look, DCF is incredible, but it has a massive blind spot. It relies heavily on expected, predictable cash flows. But what happens when an asset's cash flows are totally contingent on some future event? Well, that is exactly where our third approach steps in to save the day. And that brings us to section 2, the option pricing revolution. What's super interesting here is the actual definition. Contingent claim valuation tells us that an asset's true value might actually be greater than the present value of its expected cash flows. Why? Because those cash flows are contingent on certain events actually happening or not happening. This is a total game changer for valuation because it proves something that sounds highly counterintuitive at first. Uncertainty can actually increase an asset's value. Seriously, if you have the right to do something but absolutely no obligation to do it, uncertainty suddenly becomes your best friend. To really grasp how this works under the hood, let's look at section 3, mechanics of calls and puts. This payoff diagram directly from our source material illustrates the concept perfectly. Notice the lines for break-even and strike price. For a call option, which is just the right to buy an asset, if the underlying asset's value stays below the strike price, your loss is strictly capped. You literally just lose whatever tiny amount you paid for the option in the first place. But check out the right side. If the asset's value shoots up, your upside potential is absolutely limitless. The downside has a hard floor, but the upside goes on forever. That asymmetric payoff, that's the secret sauce of contingent claims. So how does this actually build into real valuation models like Black-Scholes or the binomial model? Well, there are 6 crucial variables at play here, but honestly, I want you to focus entirely on the second one, variance. In traditional finance, higher risk or higher variance means a higher discount rate, which just crushes an asset's value. But for options, it is the exact opposite. Because your downside is completely capped, a higher variance means there's a much greater chance the asset's price will swing wildly upward into profitable territory. Let that sink in. More risk literally equals higher option value. It completely flips the script. All right, let's step out of the financial markets for a second and into section 4, valuing real options. Let's quickly contrast financial options with real options. Financial options are your standard traded assets, like stock options. The inputs are super easy to pull up on any trading screen. Real options, on the other hand, deal with non-traded assets. We're talking about undeveloped land, patents, new tech, that kind of thing. Because they aren't traded, estimating the variables is way harder, and it introduces a ton of estimation error. But here's the catch. Despite the headache, we absolutely must value them this way, or we're going to severely underestimate what they're actually worth. To make this concrete, let's look at a really fun example from the text. When Bloomsbury Publishing bought the rights to the very first Harry Potter book, they were basically buying an option on an unknown artist. Now, on a strict discounted cash flow basis, an unproven author's expected cash flows are probably near zero, maybe even negative when you factor in the printing costs, right? But Bloomsbury wasn't just buying expected cash flows. They were buying a high variance call option. If the book flopped, they just lost their small initial advance, downside capped. But if it became a global phenomenon, unlimited upside. And well, we all know how that turned out. Let's look at another massive real-world application: undeveloped oil reserves, like the ones owned by Exxon or Petrobras. A traditional valuation only looks at expected future oil prices, but an option valuation, it captures the flexibility of the management team. The company has the right to completely delay development until oil prices go up. They also have the right to halt development if costs suddenly spike. This flexibility to wait, expand, or just abandon the whole thing is an incredibly valuable real option that traditional models just completely ignore. Now we arrive at Section 5, and honestly, this is the ultimate surprise of this explainer: equity as a call option. I want to pose a bit of a dilemma to you. What happens when a deeply distressed firm has way more debt than the total value of its assets? Say a company has $100 million in debt, but its assets are only worth $50 million. Traditional accounting and traditional DCF valuation would both scream that the equity is absolutely worthless. The stock should trade at zero. But if you look at the actual stock market, you'll see shares of deeply distressed underwater companies trading for real money every single day. So why is that? It's because equity in a highly levered firm acts perfectly like a call option. Here's how it breaks down. Step 1. The firm's outstanding debt is essentially the strike price. Step 2. The actual value of the firm's assets is the underlying asset. And step 3, this is the magic ingredient: limited liability. Because shareholders have limited liability, they literally can't lose more than their initial investment. Their downside is totally capped. They essentially hold a call option to buy the firm back from the bondholders just by paying off that debt. The crucial point is proven right here in this specific breakdown from our source material. Check out the top 2 lines. The value of the firm's assets, the underlying asset S, is only $50 million. But the face value of the outstanding debt, the strike price K, is $80 million. The firm is $30 million underwater. There's no way around it. Yet, because this debt doesn't mature for 10 years, and because the firm's value has variance, the equity is still worth something. The time premium and the volatility mean there's still a mathematical chance the assets could grow to be worth more than $80 million before that debt comes due. That hope, mathematically quantified, gives the equity real, tangible value today. Which brings us to our final section: the value of flexibility. If you take away just one mindset shift from this whole explainer, let it be this. Traditional investors absolutely hate variance. If you're locked into a project, volatility is terrifying because it means you could lose your shirt. But option holders, they love variance. Since an option holder's downside is strictly floored by the strike price, they thrive in highly volatile, uncertain environments. The wilder the swings, the higher the chance of hitting an absolute jackpot. I want to leave you with this final, provocative thought. Whenever you're evaluating an investment, a business decision, or hey, even your own career choices, if uncertainty and flexibility are where the true value lies, are you paying for the expected cash flow, or are you actually paying for the option to change your mind? The next time you see a wildly volatile asset, a distressed company, or some unproven patent, don't just ask what it's expected to earn. Ask yourself, what is the value of the option? Thanks so much for joining me for this explainer, and keep looking for that hidden value.